Some concerns over global growth this morning, slowing down after a long holiday weekend, of course. Markets were closed yesterday for the Martin Luther King Jr. holiday. Going into the new year, monetary policy, a big focus. Here's Bridgewater Associates' Ray Dalio and UBS Chairman Axel Weber just a few minutes ago.
What scares me the most longer term is that we have limitations to monetary policy, which is our most valuable tool. We have important limitations to the effectiveness of that. At the same time as we have greater political and social antagonism. So the next downturn in the economy worries me the most.
If you look at monetary policy easing, which is, if you look at the room to maneuver, the only central bank that has any room to maneuver is actually the Federal Reserve. If you look at traditional policy moves by the Fed, they lower rate very frequently at relatively large steps of 50 basis points. The Fed can do a number of interest rate steps down if need be. So I'm not worried about room to maneuver short term. But as Ray also said, given that we've had so low rates for long, the market hasn't really priced in much higher rates. If anything, the Fed has come towards neutral. They're not quite at neutral, but they're close to it. And so going back down is an emergency measure they can take.
Joining me right now to talk more about that is Guggenheim Partners Chief Investment Officer Scott Minerd. And Scott, it is always a pleasure to see you.
It's great to be here.
Thank you so much. I want to talk about this because we were having a conversation about this earlier, myself along with Dagan McDowell and Lindsay Bell, who are in New York, and we're going to get to them momentarily. The Fed, having kept rates at such rock-bottom levels, 0% for so long, did not give us any wiggle room if, in fact, we were to see a downturn. Okay, so the Fed has raised rates a couple times, but you don't have a lot of move should the Fed have to be forced to ease. And Ray Dalio thinks they're going to have to cut rates at some point.
Well, I agree with Ray. I mean, while we might get another rate hike or two in here, maybe three, the reality is we're very close to the zero bound. And if we did get into a recession, history shows us it takes about 5.5 percentage points of rate reduction to get the economy going. Well, Maria, the only answer is go back and do more quantitative easing.
Oh, God.
And yeah, exactly.
Having said that, you said earlier that you're getting more bullish as you're here in Davos.
That's
Tell
right.
me about that.
Well, I mean, it's interesting. Last year I was here. Stocks were making new highs. Everybody was very bullish, and we all know that by February what a mess we were in. And you know, I've come to view this as sort of a contraindicator. The tone here is very negative, kind of dour almost.
Gloom and doom.
It is, and you know, yet I look at earnings are higher today than they were a year ago. PE multiples are lower, and stocks are lower. So what's wrong? I mean, I think that ultimately, you know, now that the Federal Reserve is awakened to the fact that, you know, that we might be having some pressure with the Fed on hold, you know, with China cutting rates again, reducing reserve requirements, you know, I think we're going to reignite the bull at some point.
So you would be buying stocks here?
I think so. It's a, you know, I think in the next 6 to 9 months you'll be happy you bought them here.
Dagan, jump in here. You heard Scott.
Hey, Scott, it's Dagan. But it seems like the market has been unnerved by not only the Federal Reserve in recent history, but by higher, longer-term interest rates as a response of what the Federal Reserve might do. And how much of a, on the 10-year yield, what can the market bear? Because, again, we got close to that 3.25% mark on the 10-year, and the market, the stock market, the bottom fell out of it. So is that, do you use that as a buy signal for stocks or a sell signal for stocks? What can we handle as a nation and a market?
Well, Dagan, it's been too long since I've talked to you. You know, I think that long-term rates, I've always have been of the opinion that somewhere around 3.25, that was it. We don't really have a lot of room to go above that. And, you know, when you look at where short-term rates are today, our work shows that if you get short-term rates up to around 3%, given how much debt we have on corporate balance sheets, that we will start to see some serious cash flow issues in some of these companies that have taken on a lot of leverage. So I don't think we have much upside risk at all for rates at this point. And given that, I think that's why the Fed should be patient in terms of raising rates, because it doesn't want to slow this economy too quickly or we're going to be dealing with the issues that Ray was talking about.
So where's the best place to allocate capital for you right now?
Well, I mean, short term, if you're a trader, I like equities. That's a great place to be. If you're a long-term investor, I think it's a great time to go to quality and looking at a lot of high-quality sort of 10-year sort of bonds because, as Dagan was saying, we don't really have a lot of room to the upside in rates. And being able to lock in something close to 3% is probably a pretty good play for people that are investors over the next 5 to 10 years.
Yeah, if you could lock in 3% over the short term, why
That's
not?
right.
That would take money away from equities.
Well, and that's why I think, Maria, what we were seeing is that as interest rates were rising, suddenly I had people telling me how great it was to own short-term investments in Treasury securities. And I thought to myself, boy, this is creating a lot of competition from retail for equities.
Exactly. Scott, it's great to have you on the show.
It's always great to see you.
Thanks so much. Scott Minerd, the CIO at Guggenheim.